I'm Ron Feldman. I'm the Senior Vice President for Supervision and Regulation and Credit at the Federal Reserve Bank of Minneapolis. And I'm going to be talking today about banking conditions in the 9th District for the second quarter of 2011. And just a quick reminder, the 9th District includes Montana, North and South Dakota, Minnesota, the Upper Peninsula of Michigan, and the western portion of Wisconsin. The bottom line for the second quarter was that it was a slight improvement over the first quarter, but it was a bit uneven and sluggish, and so it's certainly not back to the pre-crisis period. So what I'm going to do is I'm going to talk a little bit about our views on banking conditions from the beginning of the year, and then go into more detail about what we've seen in this quarter. And then I'm going to conclude by talking about some of the variance in banking conditions across the district. In the beginning of 2011, my forecast was that banking conditions would improve, but that it would be a slow improvement. And in fact, in the first quarter, that's what we saw. Asset quality, that is, our banks having their loans repaid in full and on time, was flat or getting worse. Profitability was improving, but was not really sustainable, and loan growth was negative. So what have we seen in the second quarter? Again, it's an improvement from that first quarter, and an overall improvement in asset quality, but there's still some areas in asset quality that are weak. Profits remain pretty flat, and lending remains pretty anemic. So let me give you more details on all of those three. First, in terms of asset quality, I'm going to show you this graph that looks at the amount of bad loans that banks have and compares it to the financial resources they have to absorb losses from those loans. And that's a pretty standard measure of asset quality. And you can see on an overall basis it improved. But what you're not seeing is that it varies quite a bit by the types of loans that banks are making. So the improvement seems like it was driven by agricultural lending, commercial and industrial lending, which is loans to firms that's not secured by real estate. Now those are important improvements and are part of an overall improving trend for some banks. But the problem is that commercial real estate lending, which is loans to firms that are secured by commercial real estates, did not improve as much as the overall picture. And since that's the area where there are many weak banks who have concentrations in commercial real estate, it's really not going to see an improvement in overall conditions until we see an improvement in commercial real estate lending. In terms of profits, those are generally pretty flat for the district. Here you're looking at a graph of what's called return on average assets. That's basically the money that banks make relative to their total assets. And this was flat. It was flat because the main source of revenue for banks in our district, or profits really, is what's called the net interest margin. Now that's the difference between the money that banks have to pay to get funds, so things like the deposits, relative to the money they earn on loans. And that difference typically is called the spread or the net interest margin. And that number is flat. Moreover, banks had to put aside more money for weak loans going forward, which also reduces profitability. And then finally, most of the 9th District banks make almost all of their money from loans. And so you can imagine they are looking to increase the number of loans they make. In contrast, you can see that year over year, they've actually had a reduction in loans. So clearly that's an important source of concern for supervisors and for banks. Now there were some areas that were more positive. In particular, the funding that banks use, generally speaking, that funding became more stable, more secure, and that would mean, for example, that banks are using more deposits, and their capital position improved. That is, capital's things like equity when a bank sells stock, and it's that money that's used to absorb losses. So those areas both improved, but I would still say in total, the improvement relative to last quarter was not that big, and we're certainly pretty far off where we were before the crisis. Now, one summary measure is captured in this chart, which shows you bank ratings. Banks are rated 1 to 5. 5 would be a bank that has a high chance of failure, and a bank that's a 1 is in very strong condition. And as you can see, the number of banks that were rated 3, 4, and 5 increased substantially following the crisis. And these are banks that supervisors consider to be in less than satisfactory condition. But it's starting to flatten out. And I think that's a good reflection of where we're at in terms of the quarter. We're not declining anymore. We're showing maybe a little improvement, but we're not back to where we were. And finally, let me conclude by talking about the differences across some of our states. And I'm going to give you an example by looking at asset quality. So this is the same measure I showed you before for the district as a whole, but now broken out by state. And you can see that the patterns are generally the same. So the worst period for asset quality was in 2009, and then it steadily improved. But the absolute level of asset quality can vary quite a bit across the states. So for example, North and South Dakota have a relatively low level of problem loans relative to the financial assets that they have to absorb those losses. And in contrast, the Twin Cities, Montana, Minnesota, have a higher level. Now, the same difference is not true in every metric. So for example, earnings are closer together. They're not as disparate. But still, we typically see that the banks in the Dakotas are doing the best. The banks in Twin Cities, Montana, Minnesota are doing worse than they are. So let me summarize. This was a quarter of some improvement, not substantial improvement, mixed, sluggish in part, and we'll just have to see whether we can have increased improvement going into the third quarter of 2011. Thank you.